Thanks, Jeff, and hello, everyone. I hope everybody's doing well and your families and loved ones are safe and healthy. I want to thank you for the time, especially during this extraordinary time of stress. Our team worked really hard on this virtual event, and hopefully you'll find some value to it. It's my pleasure today to interview John Neal. John's the CEO of Lloyd's. He assumed that role in September of 2018. Prior to that, John was the CEO of the QBE Group, a $14 billion business headquartered out of Australia, but a multinational business in 37 different countries. And QBE also, interestingly enough, has a very meaningful footprint at Lloyd's. Prior to joining QBE, John was the CEO of Ensign, which was a dedicated managing agent at Lloyd's. So he's uniquely positioned to lead Lloyd's. And John is right now leading a very significant transformation at Lloyd's. It's designed to enable greater agility, innovation, efficiency, and an improved financial performance of the marketplace. So, but John's not just the leader of Lloyd's. He's a very important leader in the commercial insurance market and a critical voice. So, John, thank you for taking the time to be with us today.
John, thank you for that. Thanks for the introduction. I think I might have you as my PR man.
There you go. There you go. Well, we have about 30 minutes, so let's get right at it. And I'd ask our audience to please send in questions as well, so we can make the most of our time with John. But let's get right to it. John, obviously, during this extraordinary time of economic stress, the insurance market is also dealing with some financial challenges of the past, and prices are increasing. Why are prices going up right now?
Yeah, it's a great question. I think the insurance market really took a long time to reconcile itself to the financial crisis of 2007, 2008. It completely transformed, if you like, the P&L of an insurance company. You were going to make less money on your investment return than you used to, and you had to completely rethink your operating model. I think it took time for that to come through, and then of course we had that quite heightened period of cat activity through 2017, 2018. So I think we've been through a prolonged period which has been quite challenging for insurers. I don't expect any sympathy for that. And then you began to see a reaction with some adjustment in pricing a couple of years ago, and add to that some more cat activity, and dare I say it, the impact of COVID. And we're probably in a sustained period of price tightening and price rising. The last thing I'd say, John, is that the odd thing with the insurance industry, there always seems to be this juxtaposition, doesn't there? When businesses are finding it toughest, insurers tend to be one of the few industries that do well, maybe because risk is at the forefront of people's mind. They're more prepared to buy the product and pay a high price for it. But it's certainly an odd thing to notice. Yeah.
So there's a lot of discussion amongst leaders in the insurance industry about the impact of the financial impact of COVID. Of course, it's a human tragedy and a health crisis first and foremost. But what's your view? Will COVID be the largest loss to the market ever?
It's a great question, and we first sort of updated the street in May with what we thought the cost of claims would be to the Lloyd's market, the amounts that we'd be paying to customers. And we think that number is about $6.5 billion in total, which includes insurance and reinsurance components. Mm-hmm. And because of the way we report losses, we tend to get ahead of the curve and are quite good at projecting loss forwards, and wanted to try and get some context around what we thought the macro cost of COVID would be. And our rough estimate was $107 billion US, actually, for insured losses. I'm sure we'll end up talking about where insurance hasn't applied and what we might want to do about that in the future. Add that to the volatility on the balance sheet, because obviously, as you know, insurers collect the premiums, they hold the premiums to pay for claims in the future. I think we all anticipate that we're about to head into the biggest recession the world's ever seen. An uneven recession, but a big recession. And we think the impact on the balance sheets of insurers could be roughly the same size, i.e. $100 billion. And we don't often see the balance sheet hit at the same time as the P&L. So the two together at $200 billion probably make this the largest event, in inverted commas, that the industry's ever encountered. Some would argue asbestosis, I guess, against that thesis, but I think, yeah, it's going to be there or thereabouts.
That meaningful. Yeah, I think, on the one hand, I think on the asset side of the balance sheet, right, financial markets have rebounded quite a bit, but you're right to point out the recessionary environment, and then of course interest rates, it appears are creating an issue of lower for longer, right? And that's an important part of the math, of an insurance company trying to generate returns. So you think we're still some time away from rate adequacy then? Is that your view? I mean, obviously it's line of business by line of business.
Yeah, I think we are. The underwriter will try and calculate the technical price. I think some lines of business would be pretty close. If you look at, direct property business, I would think if you look at US direct property, prices could be up over the last 4 years, 60 to 70%, very, very dramatically. So that would be pretty close. But I think on some of the casualty lines, it's got a way to go, particularly if we start to see some recessionary impact come in and impact those lines of business, which they must inevitably do. The sort of reverberating effect of COVID is inevitably going to go through to the financial lines, and ultimately will have to go through to workers' comp and some of those other business lines as well. So I would say not great news for everyone listening to this call, but I think prices in 2021 and 2022 will continue to rise for the basic insurance products we're talking about.
I see some opportunity, and just looking back to the financial crisis, where when you have an economic shock like we're dealing with now, the opportunity, everything gets repriced, including risk. And what I've been advising a lot of clients at Marsh is to try to take advantage of that opportunity, get some claims settled, maybe at a value that we couldn't have pre-COVID, and maybe that gives us the trajectory to ultimately stem the rising cost of risk that was happening, I think, with loss cost inflation on the way into 2020. And so I see that as an opportunity for us as an industry, and working with our clients, of course, as well.
I agree, and I think one of the things that I guess upsets me most is that we're sort of sat with this balance at the moment of many clients, feeling, harshly treated by insurers because cover they thought they might have had, they've been told they didn't have, at the same time as others just simply not having cover in force. And, I sort of scratched my head at one end of the spectrum and saying, does anybody actually buy insurance unless they have to? If a bank facilitates a loan and says, right, you must buy insurance, someone goes and buys it. How many people would actually buy, insurance for their property unless their bank told them they had to? So there's something in there around education that's on us as an industry to really better explain the value proposition of transferring risk to our balance sheet. At the same time, as I think, we talk about the intangible versus the tangible world, but as an industry, we're just not doing a good enough job in getting that message across. You and I have been involved in IP insurance, intellectual property insurance, for 15 years. No one buys the cover. No one buys the cover. And we talk about cyber insurance till we're blue in the face. Actually, just for people on this call, no one outside the US buys it. 10% of the world's flow is outside the US. So there's so much that's intangible that impacts the business today. I think right at the beginning of that, starting with us as an industry, we've got to go right the way back through and say, what products and services, how do we translate the value proposition? How do we ensure that society is just better covered?
I agree. It's incumbent upon us to show the clients the value right behind, whether it's IP or cyber, for sure. So normally, you and I have been in this marketplace for a long, long time. Normally when you see these kinds of price increases, capital, new companies will be formed. There'll be businesses opportunistically reloading on capital to try to grow their businesses. And my view going into this marketplace was that prices wouldn't rise as much as they have right now. the shock on both sides of the balance sheet, I think, created a bit of a different scenario. And you talked about the possible economic impact, but what's been surprising to me is we've not seen a lot of new company formations, at least to date. Obviously, it takes a bit of time. But what are you seeing happening in the market, and what's Lloyd's doing, assuming you think it's an opportunity to attract new risk capital?
Yeah. So I agree with your thesis. I'm wondering, and we sort of saw it in your world a little bit. I wonder whether we see consolidation first before, let's say, regeneration in terms of capital. You guys with the acquisition of JLT and the Red Shop going through an acquisition of Willis Towers Watson. I think inevitably you're going to see some of that on the insurer side. There's some powerful, well-capitalized insurers out there. You think of, Chubb at home in the US, or Allianz, the big European German insurer. So I think you're going to see a bit of consolidation first. They've got the firepower to do that. I think we're beginning to see some hint of new capital coming in, but it's slow at the moment. And I think it's uncertain. If you're holding capital, there's nowhere to go for your money, as you just hinted a moment ago. I think we'll see negative interest rates in the UK for the first time in our history. They're already negative in the US. Risk-free rates are 35 bits globally. They've got to think of somewhere to go with the money, but I think there's just a bit of caution, and I think it'll take another 6 to 9 months to play out, candidly. So I think we might see something different when we're having a conversation in 12 months' time. But I think consolidation first, before we see big moves for new capital. What we've tried to do at Lloyd's is sort of broaden the sort of flavor of capital that we'd support. And we're doing that a number of different ways. So, we were behind the Bermudan market in supporting ILS, index-linked security capital. So we've now set up the infrastructure for that in the UK. It's different to Bermuda. I'm not saying it's worse or better, it's just different, but that's set up. We've also tried to allow businesses to fast track into Lloyd's. So, the regulatory environment, God, it's pedantic and slow. So we've said, let's just fast track this to 90 days for syndicates that have specific purposes. So we've done that, and we've had, a variety of different syndicates have set up, the most recent of which actually is expressly for the purpose of ensuring the transportation of vaccines for COVID. And then the third thing we've done is try to sort of recognize where the digital world's going, and we've actually sanctioned a first syndicate that's AI. It's a non-human syndicate that in fact puts capacity and capital behind a leader to enable that transaction to happen more quickly and hopefully more economically. So we're trying to be innovative. I think it's our job as our marketplace to be innovative. But the macro thesis, I just think there's a bit of caution out there, and it'll take a bit of time for that caution to settle.
Thank you. You mentioned intellectual property and intangible asset risk. For me, a lot of conversations I'm having with clients in 2020 are more oriented around resilience, where I would say prior to 2020, there was it was more conversation about efficiency, right? And so, clearly for me anyway, as the leader of Marsh, not speaking to how we advise clients, but for our business, making sure we have the right balance between resilience and efficiency going forward is certainly one of the takeaways from events of 2020. But from a client point of view, I'm getting asked more about tail risks, than ever. And what kind of value can the marketplace provide? You mentioned cyber, but maybe we could start by talking about prospective pandemic risk cover.
Yeah.
What's your view on that? I mean, obviously the economic losses here have been enormous, in this global event. But what's your view on how the industry can or should not play a role in that?
Yeah. I think it's so macro thesis, and what you said is quite important. I think the world went very short term in terms of its thinking. When you think of all businesses, our businesses included, being focused on taking cost out. Cost isn't a strategy; it's a holding pattern. It's a strategy in the absence of growth. So I think I think if anything, if there's a bit of good that's coming out of the pandemic, it's forcing us to have to innovate and think differently. And I sort of break it down into three buckets of short, medium, and long term. Short term, we've got to design a product in our geeky language for non-damage business interruption insurance. Most businesses are intimidated by something interfering with what they do. They don't know what it's going to be. I mean, it could be a fire. It could be as simple as a classic property loss. It could be the intervention we've seen from the pandemic. It could be a supply chain failure. So we've said at the front end, hey, look, let's get our skates on and see if we can get a non-damage business interruption cover up and running for 2021. Mm-hmm. Probably small, quite small limits, $20,000, $30,000, $40,000. Let's see if we can run that and see if that makes good sense. I think in the middle, the debates will rage as to whether you need a pandemic in a similar fashion to the various terrorism pools that were set up post 9/11. I'd argue that you need to go one step further, because we kind of got to stop solving yesterday's problem. We're talking about systemic risk, right? And it's hard to evaluate what the next issue of systemic risk will be. And what we do know is that it requires government and private partnership. If you look at just US debt's increased by $6 trillion so far through the pandemic. That's 2.5 times the surplus of the entire reinsurance industry in the world. So there's no way the insurance industry can deal with systemic risk on a wholesale basis, but it can do in partnership with government. So I think you've got to have, and we've called it black swan re, you've got to have a more macro solution, which is designed to intervene in these situations which are completely outside the norm. And actually, I think as an industry, we can help, because the majority of the premium that we receive, the intention is to pay that back to the customer in their time of need. So we're quite used to flowing the money, I think, between us. So I think longer term, it needs a more macro conversation around systemic risk and a bigger, broader solution that's a public and private partnership.
I was going to say that black swan re is a public-private partnership. Right?
Yeah, it is.
I mean, my own view is, regardless of the risk sharing between the private market and governments around the world, the industry has a role to play in improving the risk hygiene, regardless of the risk. We do that well. It's one of the things we do fairly well as an industry, and I don't want to see the industry sit it out. There are issues out there that, and one of the major issues you referred to earlier, you talked about the lack of penetration of insurance into cyber risk, but are we prepared as an industry and as global economies, U.S. economy, UK economy, for a systemic cyber event?
No, nowhere near. I think, I'm hoping that this will get that debate properly on the table. So unlike the issues with business interruption insurance, I'm confident that the cyber policies work. Someone specifically bought a cover for a certain set of circumstances, and I've had a good read of those wordings myself. So I think where people have bought cover, they've got cover. But we do it. You've done it with Marsh, and we do it at Lloyd's. We sort of model different scenarios of sort of reverberated supply chain impact through a ransomware attack or aggregated cyber attack, and we come up with magnificent numbers of anywhere between $100 and $200 billion for the loss. And I think if the pandemic's shown us, these things aren't theories anymore. There is a reality to them. And if you look at the insured penetration, it's single-digit percentage numbers. So in that instance, you'd see a similar situation with significant underinsurance. And the industries, we were chatting before we came online, weren't we, about the conversations you've had with cat risk previously. If you think of a major US hurricane, today the industry would model and insure a cat at about 240 billion US. So the capacity and the capital is there within the industry today to take the impact of, let's say, a $250 billion loss in a specific geography. I think introduce some third-party capital, you could get to quite a big number. But it's just getting the I guess it starts with education, it starts with the right product design, but just getting the penetration, because the more that the product is sold, the cheaper it will come by definition, really, because the age-old theory, the premiums of the many pay for the loss of the few, comes to the fore. But it's the one thing I think we need to do a lot of work on, John. I think there's such a lot of intangible exposure on balance sheets that could be insured, and we need to work out how to do that. To your earlier point around public-private partnerships, you will have found the same with your conversations in the US. We found it in the UK. Governments really can't get their head out of Tuesday week. There's just no strategic long-term thinking at the moment, especially in the US with an election in front of us, but there's no strategic long-term thinking. So I think doing what you're doing today, events that you're hosting, getting this conversation running, and then putting the pressure and responsibility on us to come up with the right products and services is just critical.
Thank you. So just getting some questions coming in from from our audience here. One is on captives, so maybe I'll ask you. You obviously to some extent you can your marketplace at least competes with self-insurance. We've certainly observed at Marsh that our clients, given the economy and given rising prices, have retained more risk, whether they've done it through a captive or just buying shorter limits or higher attachment points. It's happened in a variety of different ways. But how do you view captives? I'm going to adapt the question a little bit, but as a threat to to the Lloyd's marketplace, and at the same time as a tool for particularly our larger clients to help them manage risk.
I think they're a brilliant tool. I think they, particularly when you get to the sort of mid-large corporates, I think it should be part of everybody's armory of the way in which they look to take divisional risk or sector risk and concentrate it more. I worry a little bit that the concentrated risks in captives could be quite tricky, that there are some quite big systemic risks that are building up within the captive market. We've seen it with the pandemic. It looks like a risk to throw into a captive. When it happens, it's tricky. Workers' comp, there's some exposures to think about. We've got a piece of work running at the moment, John, to facilitate captives being at Lloyd's. And that's something we'd like to translate into 2021. We need to do it quite carefully because the structure and intent of a captive is very different to the structure and intent of an insurance company.
Right.
But we think that could be quite a neat way for you, actually, particularly representing the client and their captive, to think about introducing some third-party capital to support the captive. So I think it's a really important sort of arrow in the quiver of how you protect risk. Our thinking is that we could use the Lloyd's platform to get some third-party capital in there as well that would be a little bit different to traditional insurance captive to help in that. One of the joys of my job is I can be sort of quite agnostic as to, when is capital, when is distribution, and what does the customer want. So yeah, captives, I think there'll be some interesting ideas coming out of our market in the next 12 to 18 months. Yeah,
I could see some real appeal, to, if you could compete with some of the other efficiencies of other captive domiciles to be able to do that in the UK market. I think there's a lot of possibility there. That's terrific. So does maybe not just COVID, but all the events of 2020, the economic distress, remote working as a result, everything, does that accelerate the digitization of the industry?
Yeah, massively. I think, I think most people will have a sort of vision of Lloyd's, and they'll have seen the underwriting room, which on occasions looks like a Victorian schoolroom, thinking, are those guys ever going to get into the 21st century? And the answer was, yes, we had a plan. But it was interesting when we went into lockdown, we put some electronic trading mechanisms in place, and there was a rush from the naysayers to get the training courses completed so that they understood how to effect the transaction. So we will have seen a 66% year on uptick in terms of electronic trading activity this year. And our plans, which take us through end 2022, are to completely, it's not evolution, it is revolution, to affect the execution of the transaction, to do something in minutes that's previously taken weeks. And we've got a plan, to be able to do that. And the overarching objective get candidly, is to be able to take the frictional cost out of the process of buying insurance with one objective, and that's to take the cost of the product down. And I've been really clear when I talk to the investor community, when they say, great, cost of doing business comes down, so do margins go up for insurers? I'm saying, no, volume should, because the whole purpose here is to take the cost of taking the product down to encourage more product to be bought. So I said, you should see greater flow, but not necessarily greater margin. So absolutely, I think this really does put a sort of a shot in the arm, if you'll pardon the pun, for the digital world in insurance.
Certainly, just from a human behavior, it forced everybody to throw out the muscle memory of the old way of doing things, right? And to use some of the tools that have been on folks' desktops for a long time.
Yeah.
So yeah, it's definitely leading.
We reopened the underwriting room September 1st. It had never been closed in peacetime, ever, in 333 years. But we used the downtime to make the room both virtual and real, so that the room can operate virtually now. So it can do what we're doing today or operate really. And the neat thing there is, if you think of Marsh broker in London can connect in with the Marsh broker in New York, potentially connect in with the customer and have that conversation taking place. So even very, very quickly, we've tried to make some sharp changes so that the world that people come back to looks and feels different.
Yeah. Some silver linings through some, pretty tragic events this year, for sure. On the tragic event front, you and I have talked about the importance in our industry to be more inclusive and to attract more diverse talent. Can you talk for a bit about some of the goals you're trying to achieve there in London?
Sure. I mean, for me, we've got three strategic pillars. Making sure that we can perform, and performance is about making us the most attractive marketplace to be in. We've talked about the digital strategy, and the third is culture, setting the right tone and representing the best that the society should represent. If we succeed in the first two and fail in the third, we'll just simply fail. And having been away from London, as you said, I was in Australia for 7.5 years. When I went down there in 2010, federal government had mandated gender equality. And I thought, wow. And actually you go through the thought process and think, do you know what? It's for all the right reasons, to be representative, to have, that sort of clarity of benefit that you get, not just for the customer, but just for the well-being of the own organization. So, we had some pretty difficult issues to tackle in London, particularly around gender. For the first time, we've jumped up and put targets out there. People don't like targets, but it makes a difference and people will work to them. In my world of running Lloyd's, we are at parity, and we've done that in under 2 years. So when people say cultural change takes decades, it doesn't. You just have to want to do it. If you want to do it, you'll make it happen. And the same is true for us around, our Black colleagues and colleagues from, minority ethnic backgrounds. And we'll tackle those issues with exactly the same vigor that we've tackled gender. So, and I can feel the difference. Even in 2 years, I can feel the difference it's making to the marketplace, which is such a benefit. And I think everyone around, us is seeing that as well. So, we're as determined to set the right cultural tone and framework as we are to get performance right. And it's so important when you look at the generation. I got a 16-year-old and a 14-year-old at home, and their agenda is very different to mine. But actually, when you've got to listen to them, and the conversation we're having around culture or the conversation we have around sustainability is important. And if we want to persuade people that our industry has a real value proposition in the future, then we have to get things like culture, things like sustainability right. So as important as anything else we're doing at the moment.
Yeah. Well, my 18-year-old, 20-year-old, and 25-year-old have been very happy to share with me how ignorant I've been on a wide range of issues, certainly throughout 2020. It's, on a personal level, I've learned an extraordinary amount about racial inequity. On some level, candidly, it's a bit embarrassing. And, I know I need to be more of an ally, and I know you've been an ally. So, I really appreciate your leadership on the issues. And, as it relates to race, I think one of the real challenges for our industry is, as opposed to gender, where we aren't underrepresented at every level. We're underrepresented at senior levels. As it relates to race, we have work to do, at most
Great.
levels in our industry. And so, but your focus and leadership is terrific. So thank you. I always enjoy speaking with you, John Neal, and I always learn a great deal in speaking with you. And so we really appreciate you taking the time to share your thoughts on what's happening in the industry with our clients and guests on the line here. So thank you again.
It's been a pleasure to be with you, John. Thank you very much.
All right, we'll see you soon. Jeff, I
Indeed.
think back to you.